By listed infrastructure, we mean the kinds of physical critical assets that we rely upon in our everyday lives. So within economic infrastructure, we would look at utilities, we'd look at energy infrastructure and transportation infrastructure, and we extend our definition to social infrastructure, assets such as hospitals and schools, and then finally an evolving category of infrastructure, which includes the very fast-growing communications infrastructure, which we are increasingly relying upon as we live in a more and more digital society. Well, we tend to be quite agnostic with regards to the interest rate environment because of the kinds of businesses that we invest in. There can be short-term volatility and turbulence around rising interest rate expectations, such as what we're seeing today, but the kinds of businesses that we invest for growth. And typically it's the same drivers of higher interest rates, such as inflation and economic growth, that can be quite beneficial to the investments where we're positioned. Well, in an environment such as this, where we're having some questions around interest rates and some volatility, it's really the structural growers. So infrastructure that can grow structurally regardless of the economic cycle. And as a great example of that would be communications infrastructure, as we increasingly need more connected devices, more data, more bandwidth, and so on. And as we move into this increasingly digital society, communications infrastructure can grow in a very structured and a very consistent way regardless of the cycle. Well, listed infrastructure in and of itself is a great diversifier. We see it sitting somewhere between the broader equity market and indeed fixed income because of its characteristics. Lower volatility, a premium dividend yield, and a growing cash flow stream over time is a great way to diversify client portfolios in an asset class that's typically not been available to them, but with this listed infrastructure strategy now is.